My last question for you is today the company is somewhere $650 million market cap. The $1 billion numbers out there. I've seen you tweet about building $1 billion strip club empire, the whole thing. What is the importance of that number? And is there something that you think kind of that $1 billion mark unlocks other than just the fact that you can say that you did it?
I think it's going to add a validation to our company. I think some people still look at us as a strip club company. They're just in the strip club business. They're just strip club guys, or they're just strippers. I think with $1 billion market cap, corporate America has to go, wow, and pay attention.
All right, guys, bang, bang. I've got Eric here with me. Eric, I thought a great place to start is you guys own a ton of nightlife, restaurants, and strip clubs. What exactly is the business model for these strip clubs? Is it just ticket sales and then some sort of fee that you're taking from all the tips and kind of the girls' earnings? Or what exactly is the business model for these nightlife establishments?
Well, the business model is obviously sell alcoholic beverages and food, merchandise, the VIP room rentals, of course, up sales of, premium liquors, tobacco products. I mean, we sell basically everything we can. Cover charges. There's lots of ways to make money in our industry.
Is there anything that would stand out for people who aren't familiar with the business in terms of something that's much more high margin than they would think, or is it really just alcohol sales and kind of the things that you would assume are the high margin items?
I mean, typically we're 40 some percent alcohol sales. 40 some percent service revenues, which are, cover charges, VIP room rentals, dance dollar commissions, stuff like that. And then the rest is basically food and merchandise, which is typically 8 to 12%.
Got it. And then how do you think about marketing in today's day and age, right? You have these establishments that a lot of folks would say, obviously, the American economy is going to continue to use all sorts of different vices, et cetera. But at the same time, we have these new tools where you can use social media, you can use, email newsletters, all that type of stuff. How do you guys think about, kind of old industries that obviously are still as prevalent today as they ever have been, but there's new marketing channels to go ahead and leverage?
I mean, most of our marketing is social media now, whether it's Google keyword searches, whether it's, TikTok videos, whether it's, my personal Twitter account, actually, my Rick CEO Twitter account is a big form of marketing. I'll post that, hey, I'm going to be at the fight tonight at Scarlett's in Miami. Anybody want to come have a drink with me? And, when I first started doing that a year ago, I'd get 4 or 5 people show up. Now, I mean, sometimes we get 20 plus people show up, hang out, we drink, we watch fights, we hang out with the girls, have a good time. So it's all these methods have been fantastic for us. Instagram, I know a lot of the entertainers and wait staff, have big Instagram accounts and big Instagram following. The feature entertainers, we're starting to embrace more of these feature entertainers because they have 3 million, 5 million, 8 million plus followers. Following their accounts, following them, around the country. They do clubs all over the country. And when they come into a certain market, they're followers in that market. And sometimes people travel to see them. It's actually been really amazing to see the scope and level that these entertainers, as far as followings, have.
Yeah. Well, what's fascinating to me is just looking at this from a pure business perspective is there's a number of different things you all have to deal with or have to kind of navigate that I think other businesses are going to have to navigate 2, 5, 10 years from now. And so one of these you're hitting on right now, which is that the folks who are coming into these night clubs, they are employees, they may be contractors, but they actually may have bigger megaphones than you all have as an individual business or establishment. And so how can you leverage it? And then also, like, what are the things that you wish you could do, but because you don't own the channel, you can't actually use it to promote the establishment?
I mean, they absolutely have a bigger megaphone than we do. I think one of the challenges in the future is making sure that your influencers are happy that work in your business because they're influencing a lot of your business, right? If they're unhappy, they're going to influence it that way. If they're very happy, they're going to influence, in a positive light. And so these influencers are growing. The amount of influence they have is growing, especially in the demographic 35 and under. Traditional radio doesn't work anymore for very many demographics. Maybe some of the Hispanic market. Radio is still good for Spanish speaking clients. But other than that, I mean, it's all on demand. It's all streaming. It's all immediate. And if you don't have ties into that, I guess that marketplace, how are you going to draw those customers into your business? I think we're seeing it everywhere. And I think you run risk, right? Because now you've got to be careful politically. You've got to be careful, socially, and you got to be careful who you back and who you use to influence your customer base. Because if they influence them, the wrong way, you're going to have negative effects from that. So it's a much more complicated landscape than we've ever faced in the past, where you just called up the newspaper and put an ad in the sports section, right? Those days are gone.
Yeah, one of the things that as I was kind of thinking about this conversation is you have the blessing and the curse. You've been doing this a long time, right? 20 plus years as
almost 30
kind of public company.
Yeah.
So you've been doing in the industry for 30 years.
28 as a public company, 28 as a public company, and about 36, 37 years total in the industry. Yeah.
So if you think about that, like you have a bunch of institutional knowledge, you've got a bunch of stuff over the years that you've learned and kind of perfected and become an expert. At the same time, technology shifting, the market shifts, that there's different political climates, et cetera. How do you stay kind of on top of the new stuff while also understanding what to take from the experience and the expertise built up over decades to continue to build out a great business?
I say the best part is our staff. The majority of our employees, majority of our entertainers are 18 to 30 years old. And if they've been in the industry past that, they're typically moving into management or moving into, other positions in the company. But we still have the majority, 80% probably of our staff is under the age of 35 for sure, probably under the age of 30. So we're very in tune, and we listen and we talk, and we have to take guidance from these new generations on how things are working for them, how their peers are viewing not just our industry, but just how they're going to spend their money, where they're going to spend their money, and why. You see a major shift from material possessions to experiences, and I think that using social media and using our current staff and entertainers to get that message out that we are an experience to be had, not a product to take home, so to speak, is doing wonders for our business overall.
Now, one of the aspects of the business that you seem very concerned with, very obsessed with, is free cash flow. And obviously, given kind of the rise of tech companies over the last decade or so, it's been growth at all costs, but growth really of equity value. How can I appreciate the capital, but not necessarily drive free cash flow? Talk a little bit about what you all are doing inside the business to continue to optimize for that free cash flow. Sure.
Well, prior to 2015, we were operating like a tech company, growth at all costs. Let's buy this. Let's it's not making as much money, but we'll grow our revenue. And our free cash flow, especially on a per share basis, was stale for about 3 years. That stuck around $14 to $15 million. In 2015, we developed our capital allocation strategy and said, look, it's not just what we do on a top line. How do we get that to flow down? And we want about a 20% free cash flow margin at the bottom line. So if we do $1 in revenue, we need to get 20 cents in free cash flow from that sales. And so we started really reevaluating everything. It started with assets and invested capital. We sold off a bunch of clubs. We weren't making the money. We changed, we reformatted, and we really started focusing on free cash flow. We locked down our equity. We paid off all convertible debts. We stopped warrants. We stopped, stock options, anything that would dilute our capital structure. We went from total outstandings. We started buying back stock because our free cash flow yield was over 10%. So we went from 10.8 million fully diluted shares down to 9.4 million that we were at today. And we're, when the stock's below a certain threshold, we continue to buy back stock. If that's what we think is, the best use of the capital. We've been in stock buy. We bought some stock back in the last quarter. We're going to be buying stock in this quarter, with our stock at, $65, $66 a share now. So we will continue to follow that capital allocation strategy. But what was really, I guess, transforming for me was, at first it was just the assets. Then we started looking at the human capital, right? If we're paying a person X, what are they doing to bring in future revenues, right? And that really changed what I call the entitlement culture at our company, or any company really, right? I've been here for 25 years. I've done all these great things for the company, and I'm entitled going forward to continue, collecting that money forever. And which is fine to a point, but at some point you're bringing negative ROI. And so we have to figure out, what you're going to do to bring forward. And I think, I ask myself that question all the time. What am I doing? If I'm going to get this much pay, yes, I did all these great things for the company. I've been paid for doing those great things for the company. And if I want to continue to get that pay, I have to continue to do great things for the company. And as that really moved through our culture in 2016, 2017, you really kind of saw, right before COVID hit, we were in our stride, right? We were now sprinting down the runway, so to speak. And COVID hit, we had to reevaluate. We had really taught us the next lesson of how much fat can we cut? How much fat do we really have? How many things were we doing? How many processes do we have in place? How can we lower costs in processes? Were we renegotiating every single aspect of every dollar we spent? And during COVID, we had to do all those things. And so now every year we sit down and we go through and we question every dollar we spend, especially if we're, getting to the point where our free cash flow margin is not 20%. We want to keep that free cash flow margin flow through at about 20%, 30% EBITDA, 20% free cash flow. And so that's our internal goals.
Talk about the stock buybacks. One of the things that over the last couple of years has obviously become much better known is some of the best performing stocks, some of the best performing CEOs. They did a fantastic job on the capital allocation front. They bought back stock when it was cheap, and it was able to kind of engineer a financial return for investors that was very, very attractive. And so being able to pull down your shares from just under 11 million to, kind of just under 9.5 million now. Is there a number that you're trying to get to eventually? Is there such a thing as having too few shares out in the market? Like, how do you think about, taking it to the extreme on the stock buybacks?
Well, if you have too many shares, you just split, right? I mean, I can make more shares tomorrow. Just split the stock price. Stock price cuts in half. There's twice as many shares outstanding. When we buy back, we're buying back at a lower price. But we can keep the count up as high as we want. To me, it's not about the count. It's about how much free cash flow per share are we generating. And so we take our free cash flow versus our number of shares, and you end up with the free cash flow yield of if it's over 10%, we tend to buy back stock more. If it's under 10%, we tend to make other acquisitions. When it gets down to 6 and 8%, we'll use it in transactions. Like the last transaction we did in March, where we issued shares at $80 per share. $16 million worth of stock, 200,000 shares. We had just bought all those shares back under $60 from a previous acquisition. So we used 200,000 shares in one acquisition. We bought them back. We issued them at 60. We bought them back under 60, and then we turned around and issued them at 80. When you're doing those types of things, it's very accretive to the free cash flow for existing shareholders. And I think, like I said, at financial advisors, grow, and equity was cheap because you didn't have to pay it back. Well, actually, your equity is the most expensive thing you can issue if your free cash flow yield. If you're buying stuff at a lower yield than you're yielding on your own current assets, you're basically trading some of your own assets to acquire new ones. And that didn't. Once I figured all that out, it just didn't make any sense. And I think it's a common mistake out there in growth companies that you must grow and you must grow and you must grow. And we've come to the point where, yes, we must grow, but we must grow right. We will pass on transactions if they don't make sense. If the math doesn't work, if we don't feel confident that it'll add to our free cash flow per share, we'll walk or pass on a transaction. or an acquisition. We're building new stuff, but on our new stuff, we demand cash on cash returns of 25 to 33%. We will use leverage returns. I mean, if I'm using bank financing, but I own the real estate, to me, that interest expense is just rent, right? And my rent goes down because every time I make a principal payment, my interest expense decreases. Whereas average, company out there, restaurants, chains, whatever, they're leasing everything. And so their rents continue to go up, right? 2%, 3% every year. I tend to get 5-year fixed rate. Sure, my rents could go up, in 5 years because my interest expense could go up. But right now we're locked through about 2026 on most of our financing. We will be looking in middle of 24 through the middle of 25 on what we're going to do on a refinance of that real estate. If the interest rates are low enough, we can pull cash out, but something that your landlord doesn't give you any of your money back or let you borrow any of the money back for future growth. So I think our real estate's become an incredible asset for the company in that regard as well.
When you start thinking about M&A versus building some of these facilities, what is that really? Is it just come down to pure financials, or are there certain things that you also incorporate into that decision making?
No, I mean, it's basically fifth grade math. Everything goes on. Like I said, get back to free cash flow. The issue is I can't guarantee a growth rate of 10 to 15% with acquisitions alone, because I can't tell you when I'm going to get licensing approvals, when someone's going to be willing to sell to me at a price that I'm willing to pay. And so we look for ways to grow organically through the building of the new Bombshells restaurants, maybe a new club here or there. Of course, now the casino properties that we're doing in Central City, Colorado. And so we want to have the organic growth combined with the acquisition growth so that we can steadily and consistently grow our free cash flow per share at a 10 to 15% clip. Now, when we were doing $75 million in sales, 10 to 15% growth was not that hard. But in 15 million in free cash flow. But now that our free cash flow is, getting in the 60 million range, now you're starting to have to buy a considerable amount of new EBITDA to convert down into that free cash flow and keep that growth rate going, where we're getting to 80 million, 100 million, 125 million in free cash flow. So it does get more difficult, especially to do it just through acquisition.
Yeah, so there's more details here that I think people who are unfamiliar with some of these decisions, they're not quite aware of. So, for example, you guys have Bombshells, which is in Texas, I believe. And for the kind of a layman description, it would be like a Hooters, but more military themed. And it's a chain restaurant. Now, when you look at that location, you can go and you can build a 27th or whatever it is location, a 28th, 29th, the 30th location. You're basically taking an existing brand that works, you've got a system in place, and you're essentially creating just another location, an extension of that, versus if you were to go in and try to build a brand new brand, a brand new location, a brand new concept in some city somewhere and start from scratch. It would seem like the Bombshells kind of just another location would be the easier decision, right? Because you kind of have a lot of stuff already figured out. But is it lower return profile versus building a brand new nightclub, for example, and a new concept, new brand in a new city? Like, how do you think about risk and reward when it comes to where you're going to go build something new?
Sure. So with the clubs, obviously have a moat, right? No one's going to come compete with me anytime. With Bombshells, you've got other brands out there that can come and build and compete. And so your longevity is not guaranteed as long as the nightclubs are. So we prefer the adult nightclubs when we can do them. But also, the Bombshells are not inexpensive to build. So to build a quality competitor has to be willing to spend this, a similar amount of money, and they have to be willing to come in and try to directly compete with us as well. So there's a little bit of a moat there. Plus, with the Bombshells, we're able to get bank financing. We buy the real estate. We're able to get bank financing on it. So our upfront cost, about 25% cost of the restaurant. So if a unit is $6 million to build, we only have to come up with $1.5 million in cash. Typically, we cash on cash return that anywhere from 14 months to 38 months. So our cash on cash returns meet our criteria of 25 to 33%. Sometimes it's 100%. We've had units. I've also had units where we built everything out in cash, then gone to the bank, got a appraisal on the property, and we pulled $400,000 more out of the bank loan than we spent to buy the land and build the entire thing. So we're 400,000 cash on cash up day one. Every dollar we make out of the restaurant is just, infinite return, right? And so that's one of the nice things I think about Bombshells. We're going through a tougher time because we have really hard comps. We were one of the few places that opened immediately. We had all of our stores reopened by about May 15th after closing March 1st. So we weren't closed for very long with Bombshells. We were one of the few things open. Our sales were absolutely fantastic for about 2 or 3 years. So we're running against incredible comps, against, 100-degree heat outside in Texas right now. We're a patio. An outdoor patio is a major portion of our late night business, where we bring in DJs and turn our patio basically into a nightclub in the evenings. And so that business is suffering. That's all, 40% plus margin business. It's all appetizers and alcohol. But still in the last quarter, we made $1.7 million. The quarter for that, we made $1.9 million. We're already cash on cash, over 100% ROI on our cash and cash investments and all the Bombshells. Concept's over 10 years old, and we're building in Houston right now. We're building in a Dallas area. We're building in Lubbock, Texas. We're building 2 locations in Denver now. So we'll be expanding into Colorado, as well as a Bombshells sports casino that we're going to be building up in Central City with a full Bombshells restaurant in it. So a lot of exciting stuff for that concept. And like I said, the ROI on it is great. It's just been very difficult this last 12 months or so. But the comps will eventually, we're going to hit the lower comps, and things will get back to normal. And we should run 18 to 22% margins. Our margins are a little squeezed right now. We've been a little slower in bringing down our costs to the level because we kind of hoping the business would rebound. If it doesn't, we'll adjust accordingly as we're doing at this current time, and bring everything back in line. Our catio business should come back as soon as the weather breaks, and we'll be back to normal.
And then when you start thinking about regulation, obviously when you run a restaurant, you got the liquor license and things there. When you think of the nightclubs and those establishments, you've got a bunch of regulations you got to deal with. And then you start talking about casinos, there's all the gambling, and it seems like the United States is becoming more receptive and sympathetic to gambling. But how do you navigate not only just regulation in general? You actually have 3 different types of regulation that you're having to deal with here, right? And it's highly complex. But you also got to run a business. You got to keep margin. You got to keep growing. This is not as simple of a business, I think, as people may think on the surface. And so talk a little bit about the regulation, what you guys have done there.
Biggest fortunes aren't made on Wall Street. They used to be made there, but now they're being made in private markets. Consider Mike Walsh. He put $5,000 into Uber. He's just a regular dude, turned it over $24 million. Such opportunities were once held behind closed doors, reserved for those who had connections or vast fortunes, but not anymore. Start Engine is now going to tear down that glass ceiling and make startup investments possible for you and me. The company is led by Howard Marks, the co-founder of gaming giant Activision, and they got 1.7 million users that have put in over $1.2 billion of transactions on the platform. But the best part is the platform's not even backed by traditional venture capitalists. It's backed basically by the community. They've raised over $75 million in crowdsourced funding to date. Go check them out at startengine.com. You can open up a Start Engine account today, and you can explore live investing opportunities with starting investing amounts as little as $100. Startengine.com. Go check them out today.
Well, you corporatize everything and you have processes, right? We have in-house legal counsel with, 3 paralegals that work for the company full time. We probably have 9 outside law firms that we deal with on a weekly, monthly basis. So you use a lot of lawyers, obviously, but you create a lot of systems. We try to use technology to the best of our advantage to track and keep track. You have an ERP system now in our accounting office that we can run financials and get data in seconds, versus the old spreadsheet days where, it took a week to get, if I wanted to know something, I had to take me a week to find out. Now I can get it in seconds. Inventory control systems. I can tell you, I can go push a button and tell you how many bottles of any type of vodka you want to know, any certain whiskey you want to know. How many did we buy in the last month, the last week, the last 12 months? And so that data gives us unbelievable control and power over negotiations with vendors, for example, keeping our costs down, national buying power, with whether it's Coca-Cola or it's Pepsi, whether it's, Southern Wine and Spirits or Republic or, the different brands. We can go to different brands and say, we sell this amount of this brand and X amount of your brand. What could we do? What would it be worth to you if we can get your brand from 1,000 cases to 3,000 cases? Here's how we would do it through our VIP menus, those types of things. What kind of marketing support could you give us? There's laws that don't allow them to actually give us money, but there are ways for them to help us sell their product. And if they're helping us sell their product, it makes our jobs easier.
Yeah, that makes a lot of sense. And then when we think of kind of other parts of the business, technology is a huge piece. You're here talking about kind of inventory management and really having kind of granular understanding of what you guys have ordered, what you could order, what various sales are. But you've also built out a certain number of other products or services. So things like you essentially have an OnlyFans competitor to some degree to allow the entertainers to have direct connections with kind of their fans or their audience. Talk a little bit about the technology initiatives that you guys have underway.
Yeah, well, that one's being developed right now. We're trying to get a product that we can actually live launch and really put some money and influencers behind. We do have some feature entertainers we're starting to work with to start to load some content on the site. We'll probably start buying and directing traffic to that site very, very soon. The idea is that not only, if you're on a convention in Denver, for example, and you meet, Susie at the club, and then you go back home to Idaho and you want to stay in touch with her, now you can follow her on her fans website at admireme.com and keep in touch. And then the next time you're in Denver, you can come by the club and see her again. And so it also helps our entertainers build not only their in-club presence, but it helps them build a business online as well to give them additional sources of income and revenue.
Yeah, that makes sense. And then how do you think about how much of that is going back to kind of serving the entertainer and trying to provide a place where they want to continue to work and come to the various clubs, et cetera, versus it's a revenue optimization and it's, hey, how do we get money flowing through this and get transaction volume so that we then can take a fee and drive real revenue?
Right. I mean, I think the reality of it all feeds each other, right? I mean, one doesn't work without the other. And so I always have a saying with everyone: if you want more pie, we don't take somebody else's piece, we make the pie bigger. And I think Admire Me is part of making that pie bigger, right? The girls don't need to take our money. We don't need to take their money. We just need to make the pie bigger so that everybody is getting additional money that way.
Yeah, that makes sense. Private jets. I know that you are a pilot. It's something that you for a long time have been very passionate about. Talk about one, why is it so valuable for you guys to use the private jets and kind of get from location to location? How do you think about saving time and money from that standpoint?
Well, I mean, I could leave my house right now and be in Denver in 2 hours and 40 minutes. I can be in New York in probably 2 hours and 55 minutes. I can be in Miami in probably 2 hours and 5 minutes. With all the locations we have. And the real thing is I can travel at any time, day or night, right? If I want to go stay at the club till 3 o'clock in the morning and then jump in the plane and be home and be at a meeting at 7 o'clock or 8 o'clock in the morning when I get home, I'm able to make those types of things happen. If we get a call, oh, hey, there's a club for sale in Milwaukee. By the time I would book a flight, get to the airport ahead of time, check my bags, get my bags, uncheck my bags, pay for hotel rooms, all that type of stuff, because I can't get a flight back home that same night. It's just a convenience and a quality of life thing, as well as, we're fast, right? If we need to react or move something fast, we can do so. The overall cost, when you look at the tax benefits of corporate aircraft and some of the other things that, I'm not going to act like it's cheaper to fly in a private jet than it is commercial, but it's competitive, especially the smaller plane. And we have a Vision jet, a Cirrus Vision jet, which, fuel burns about 70 gallons an hour, does 300 miles an hour. So if you do the price per hour, that's $1 something an hour or $1 something a mile, which, it's not it's not crazy, but it allows us to get, I have 27 locations in Texas. It allows us to if we need to get to Odessa, Texas, I can be in Odessa, Texas in an hour or so. I can be in, if I have to be in El Paso, if I have to be in Austin, Dallas, I can be in any of those cities very, very quickly.
And then part of what I think is the most shocking is you're flying the plane yourself. Like, you don't have a pilot normally flying you. Usually it's you flying?
Usually. I only started flying about 13 years ago. I bought my first plane in 1991. So I flew in the back for a long, long time. But I have learned to fly about 13 years ago. Discovered the freedom of it. Now I don't have to worry about pilot. I don't have to worry about, if it's 3 o'clock in the morning, has he been sleeping? Has he been drinking? Can I get out of here? I need to be somewhere. And so that freedom to me is invaluable. I got to go to flight training every year, twice, 2 times a year, because we fly 2 different types of aircraft. I have 2 different type ratings. So I have to go to flight training for those. I have to, stay current. I have to fly a certain amount, but I probably fly 200 hours a year on average right now. So it's not really an issue. To me, it's, everybody says, well, gosh, you're going to go fly. It's 2 hours. I said, you're going to drive an hour and 15 minutes home. If you live in New York City, or if you work in New York City, you live outside the city, you're going to drive an hour and 15 minutes home at 4 o'clock in the morning. I'm going to get in a plane and fly for an hour and 45 minutes. Who cares? It's just my car, right? That's the way I look at it.
Yeah. There's a Forbes interview that you gave a couple years ago, and in it you talk about loneliness and kind of this idea that many of the people who come into the nightclubs, et cetera, they don't have a lot of friends. They're coming in for something that isn't, material possessions. Talk a little bit about what you've seen there, and maybe the contribution of the pandemic and people being locked at home and now trying to come back out and, kind of reintegrate as a society.
Yeah, I try to say, everybody thinks that you're in the sex business, the sex appeal is definitely part of our business, but the reality is we sell human interaction. If you look at the numbers today, the birthing rate's down, right? The number of men under the age of 30 that, aren't sexually active, don't want to get married, don't want girlfriends, don't want, so what is their release? How do they create that human interaction? And they don't know how. They spend so much time on computer screens, they don't really have the social skills. The beauty of going to a strip club is the girls have all the social skills that you need, as I would say, to a customer. So a guy can come in. We've done a couple of big parties when we were launching our NFT project. And, in Miami, we had a bunch of guys come in for the NFTs, and they're very excited about crypto and the NFTs, because crypto is very big in Miami. And they come into the club and they'd be like, wow, I didn't know it was like this. This isn't what I expected. He goes, how come the girls are so friendly? Why do the girls like me so much? I was like, well, that's their job, right? That's what they do. He goes, yeah, but it seems, they're very sincere. I said, well, because they genuinely want you to have a good time. They're not, yes, they want to make money, but they're having fun. This is a fun job for them, right? Do they want to go sit in an office or in a cubicle, or do they want to, come drink and hang out with guys and have a good time and make money? So I said, it's a win-win for everybody in that regard. And I think it helps, it's amazing how many guys are actually afraid to talk to a female. It's like, guys, just go talk to her. Well, she's pretty. I said, well, go talk to her. Well, she's too pretty for me to talk to. I'm like, there's no such thing as someone being too pretty. She's over there thinking that she's not pretty because you're not paying attention to her. You don't like her. Now she thinks something's wrong with her. She's getting a complex. So you go talk to her, and it works out. It works out pretty well for everybody, I think, in the end. So
when you start to think about kind of the business, it's gotten much bigger over the last couple of years. Where do you envision this going? Kind of what is the plan or kind of your future goals in terms of growing the business from a revenue and profitability standpoint, but also expansion? Is it going into more of the gaming stuff? Is it just more restaurants and nightclubs? How do you think about this?
I mean, everything complements. Basically, the business we're in is the alcohol sales business, right? We're in the nightclub bar business. We sell alcoholic beverages, and that's where we make the majority of our money, probably. Definitely margin wise. And I think that if you look everything we've done, the casinos, the bombshells, everything kind of builds around that core business of using some type of entertainment to then, to basically sell alcohol or sell a fun time, right? It's a good time out. It's a fun party. I used to joke. I said, "Man, this is the greatest job in the world. I get paid to throw a party 7 days a week." Where can you find a job like that? Unfortunately, my job's evolved, and now I actually have a corporate job. So I get paid to make sure other people throw the party 7 days a week. But yet I can go join the party anytime I want. And I think that's kind of the beauty of our industry is anybody can come in and join the party. We try to treat everyone that comes to our business as a guest, not a customer, as a person, not a number. And whether you spend $50 or $50,000, we want to make sure you have a good time and that you're whatever level of customer or guest level you want to be, that you're able to enjoy that.
Talk about being a public company CEO. You've been doing it for now 2 decades, maybe a little bit more than 2 decades. How has it changed over the years? Like obviously the internet and social media, like there's been a lot of change in society, but as a public company CEO, what are some of the things that have stayed constant? And what are some of the biggest changes that you've had to navigate?
I mean, audited financials are obviously very different than, a private company. After Sarbanes-Oxley was passed, the amount of regulation, I mean, it takes 4 people to get a check cut in our company. I used to go grab the checkbook and write checks with a pen myself, right? I mean, you can't even get a check. There are no checks. The computer prints them, and until there's 4 approvals, the computer won't print them. So there's not even a check to write anymore. So that's been an amazing thing for me to get used to as the CEO. You just the checks and balances, but at the same time, I think it's fantastic because everything's documented, everything's followed. I mean, video cameras, everything's recorded, everything's set. So, all the he said, she said, all the what ifs, it's all documented these days. And so it's very easy to defend any position that we have or any position we take. And so I really like that side of it. It's become a business. I mean, I remember when I first started out in the business, I mean, shoot, I was probably legally drunk. I didn't drive. I lived at the club, so I didn't have to drive. So that helped. But I mean, I probably drank every other day, 3, 4, 5 times a week. And now our management team's not allowed to drink at all. Waitresses would get drunk, and then we'd have to sober them up, get them rides home. Our wait staff doesn't drink anymore. It's become very, very corporate in that regard, which I think, like I said, has pluses and minuses to the overall deal. But it's made it a safer, funner environment for everyone involved.
And then you employ tons of young people. And if you were to go on Twitter or, go read news articles, they'll tell you about how young people don't work hard or young people are complaining about this or that, or they're too woke or they're too ESG focused or, name your critique of young people. What are the pluses and minuses of having so many young people work for you? Like there's pros and cons. What do you see those being?
Well, I think the beauty of most of the young people that work for us is they come to us with the necessity to work for some reason, right? Whether they're a single parent, whether they're, there's something in their life that has brought them to our industry. And I think our industry empowers them to not only recover from whatever brought them there in the first place, but to allow them to excel and to create a much better life for themselves and for their families. And I to me, that's my motivation. People ask me all the time, why do you keep doing this? Why do you, what's your end goal? When are you going to retire? What's your retirement plan? You've been doing this, 30, I started at 19. So I've really been in the business 36 years. It's like, I can't, there's too many people that count on me every single day. Too many families, too many, whether they're employees, whether they're entertainers, it doesn't matter to me. And our guests, our guests use our business as their, that's their social experiences. And we have a lot of regulars that are, that love our clubs. They love the entertainers. They love the management teams and the employees at the clubs, and they kind of become, part of the family. And so to me, that's the motivation and the drive that keeps me working every day.
My last question for you is, today the company is somewhere $650 million market cap. The $1 billion numbers out there. I've seen you tweet about building $1 billion strip club empire, the whole thing. What is the importance of that number? And is there, something that you think kind of that $1 billion mark unlocks other than just the fact that you can say that you did it?
I think it's going to add a validation to our company. I think some people still look at us as a strip club company. They're just in the strip club business. They're just strip club guys, or they're just strippers. I think with $1 billion market cap, corporate America has to go, wow, and pay attention. We got very close. I think we got to 900 and some million. So we got very close this past January. I think we're undervalued right now. And I think that we'll start seeing the realization of the investment we're making as we move into 2024, and hopefully we'll hit that mark. I think it's just a number. My old number used to be $30 million. I need my stock to be worth $30 million. I want a net worth of $30 million. Well, I hit that in 2008, and I said, now what? Okay, wait, that's just a number. Let's go back to work. It's actually a $1 billion market cap is probably a meaningless number in the overall deal, but it's also, like I said, I think it's a validation point for our staff, our employees, for myself, that, hey, we've actually created, a $1 billion market cap company. If it was 30 years ago, we'd probably be happy at 10 million, right? That'd be a big number. But today you got to get that B out there. And so, that's kind of the goal of it. I call it monopoly money. You play the monopoly, and, the money stacks up into your side of the board. It looks good, but you can't really buy anything with it. You can't do anything with it. But so I think that's kind of what it's about. And like I said, it does have a nice ring, right? $1 billion. So I always laugh, when you think back to that, I don't know if the old Austin Powers movie where Dr. Evil gets out and he goes, "We want $1 million." And the guy goes, No, that's not $1 billion. $1 billion. So, I think kind of, just be fun, right? The reality of it is it's not going to change anything other than probably the stock price will have to be up considerably, which will make a lot of people very, very happy, especially Adam Wyden of ADW Capital, who's our largest shareholder. I have to admit, he's been with us bought our stock in COVID, stayed with us. Other people sold when the stock hit 90s. He stayed with us. He's backed us. He supports us. I can't thank him enough for believing in us, and I think that, we're going to pay him dividends. And when the stock hits that $1 billion, he'll get his validation too, for the people that give him hell for owning part of a strip club company.
Eric, where can we send people to find you on the internet if people want to follow along as you continue to build the company?
Sure. I'm on Twitter at Ricks, Ricks CEO. That's my Twitter handle. I'm on Twitter probably every single day. I try to post, especially now that Elon wants to pay me, if I can get 5 million impressions. So I've been spending more time on Twitter than I have in the past few months. But I actually enjoy Twitter a lot. It's fun to hang out. Well, I'm sorry, X now. I better correct myself there. But I enjoy posting. I enjoy the back and forth. And what I really love the most is, I was an operations guy from 19 until, I don't know, probably 2010, 2012. And so I was daily contact, right, with the guest, with the employees. And I think, the platform X gives me the opportunity to get that feedback, to get that one-on-one, whether it's direct messaging or whether, we're talking in public forums. But it allows me to, to basically get a taste of that direct contact again, and really hear from people. whether it's problems, whether it's praise, it doesn't really matter. Whether we're just, as they call it, shit posting, it doesn't matter. It's just a way to communicate and really get a pulse of our industry, of the people that follow us, of our investors, potential investors, and really get our story to the masses. And it's inexpensive, what, $8 a month, right? So it used to be free. But
that makes sense to me. Well, listen, Eric, thank you so much for taking the time to do this. We'll definitely do it again in the future.
Okay. Appreciate you.